I'm Sivea Key, and I am the Senior Insurance Analyst for Solid Wealth Advisors. I'm one of the top long-term care planners for the insurance side of the industry here in Colorado. And I also am a trained and experienced field underwriter. That means I have to know a lot of details about how long-term care works. According to the American Association of Long-Term Care Insurance, 95% of the people who are licensed to do what I do only submit 2 policies a year, in general. That kind of shocked me. I don't know about you, but I can't imagine someone becoming an expert when they only deal with something twice a year. So let me ask you, would you feel better if you were talking to someone like me who day in and day out is so passionate that they're just digging into every detail of long-term care, or someone who just deals with it once or twice a year? Okay, so let's look at it this way. I'm going to ask you to think about, if you have a financial planner, think about them as your general practitioner. Then think about the cost of long-term care as a cancer that you might develop on your retirement income. I'm your oncologist, and my prescription is learn and plan, and that's what we're going to do today. So first of all, we're going to look at who is going to need long-term care. We're going to talk something about the costs and what's available out there to help you pay for them. And then I'm going to break down the long-term care solutions that are available. There's more out there than you'd commonly hear about if you're talking about coverage with someone. After that, we're going to look at ways you can figure out what might be the right fit for you. Sound good? All right. We're going to start with a little science experiment. So I'd like you all to just take a minute to relax and close your eyes. Imagine yourself 20 years from now. Are you out in your garden? If you're in your garden, can you feel the warm sun and smell the sweet earth that you're digging? Or maybe you're fishing. You're out in the stream and you hear the rushing water and you feel the breeze on your face. Or you're a traveler, an adventurer, and what you want to be doing in 20 years is visiting all the most beautiful beaches in the world. Or maybe your favorite place to be is right at home with your loved ones, with your favorite book, with your dog cuddled up next to you. I guarantee 2 things. 1, each of you is someplace different. And 2, you've all imagined yourselves in the same body that you're sitting in right here in this room. Everybody raise their hand who imagined that you're in your same body. Look around at all of us who just can't quite imagine ourselves disabled and needing care, and then think about the statistics that the Department of Health and Human Services discovered when they did their surveys. 70% of people over 65 and 41% under 65 will need long-term care in their life. That means almost 3 out of 4 of us here in this room will need long-term care. 3 out of 4. So the importance of long-term care planning is pretty immediate for each of you, isn't it? However, is long-term care insurance right for you? If you're the type of person that it's most important to you to protect your spouse, protect your children or your siblings from the costly burden of taking care of you, then you should be looking into long-term care insurance. If you want to preserve your independence, your lifestyle, if you want to have a say in how and where you're cared for, that's what long-term care insurance can do for you. If your biggest concern is legacy, and you want to make sure there's money left for your children, for your grandchildren, your church, or your favorite charity, long-term care insurance can help you ensure that. If you're money-wise and understand how powerful it can be to trade a small amount of money with an insurance company for them providing you a large pool of money to use for care, then you should look into long-term care insurance. It's not for everybody. If you can't stand insurance companies and there's no way you're going to buy insurance, don't do it. Self-insure, but please at least plan. If you're someone who just can't imagine that you'll ever be sick, you're convinced you're just going to drop dead, don't buy long-term care insurance. There's no right answer here. The right answer is what you decide. But please write down what you think the right answer might be for you so that you remember when we leave this room. Since we're talking about not buying insurance, guess what that means if you don't buy insurance? You're self-insuring. You're saying, I'm pitting all of my funds against the likelihood that I will never need care. But if I need care, that's all I've got. I'm paying for it all. So, wouldn't you agree you better know what it costs? How many people here have looked around at the cost of care? Okay, some of you know what it costs here. Great, good start. This is a study, these numbers are a study that were done, it was hired, Care Scouts was hired by Genworth. They do it every year. They've got statistics at least over the last 5 years that they'll publish. I don't know what else they know. How many people would prefer to be at home for care? My husband too, I'll keep him there, right? That's about $50,000 to have someone working essentially full-time for you at home.
That's a year, $50,000?
Per year. Now, here in Fort Collins, we have top-notch adult daycare. So you can save some money. It's less than half the cost of home care to use community care for part of the day. Someplace like Elder House will even help you with rehab. Assisted living, the base price runs about the same as home care. There are other costs. How many people, you don't have to raise your hand, but how many people thought that they were going to just talk about nursing care? This is what nursing care costs on average in the country. Some places are quite a bit more expensive than that here in Fort Collins. Double the cost of home care. So when you're looking at these numbers, I hope you're thinking, what kind of funds do I have to cover this? Your secure funds, things in a CD, or your investments, your securities, those are easy to access, right? They might be your emergency funds. But if your securities or your CDs are your retirement income, and that's where you'd have to dig into your payments for your home care assistant, How's that going to look if it's a year like 2008 and the stock market's crashed and you need care this year and you have to sell your stocks at a loss? That's going to affect your entire retirement. So those are difficult decisions to make. They're hard to think about, but please take the time to think about what would happen, for example, if you had to dip into your pension funds, maybe sell your vacation home or your rental properties. Some of those things are going to be taxable. The tax man's going to come and take a bite out of that $90,000 you pulled out of your IRA to pay your shared nursing home costs last year. Guess what's going to happen? What's your tax rate at that time? Is it 25%? What's your tax bill going to be? Suddenly you don't have $90,000 to pay the bills. You have to go back and pull out more money potentially. That hurts, right? So something that everyone asks me, well, what about that government stuff I should be eligible for when I'm a senior? Doesn't one of those cover long-term care? Medicare and Medicaid. Okay, Medicare, the one that most people have heard of, will indeed cover most of your costs for care, extended care, if you've had a hospitalization for treatment, not observation, for 3 midnights. And then you have to be admitted to the facility within 30 days for care. And after that, they say, well, that better have been for the same treatment that you're in the hospital for. Not easy to qualify for. How many people here know someone who has been in the hospital for anything for 3 nights? I don't know very many people. Even with surgeries, it's outpatient, isn't it? After that, it's only 20 days of coverage that they'll pay 100%. They'll pay up to 100 days if you pay part of it. So is that long-term care? Nah, it really isn't. And you know what? If you get out their book, you'll see somewhere in there, Medicare and you, we are not long-term care. So they're expecting you to know that Medicaid is the policy that actually, the government policy that actually works to make sure people get the care they need. However, their requirements are that you provide 5 years of your financial records. And they're going to make sure that you didn't squirrel away some assets in some kind of revocable trust, or maybe sell your vacation home or your family's second home for $1 to your kids. They're going to make you spend that money before you qualify, even if you don't have it in your possession anymore. Generally, you have to spend your assets down to the point where if you're single, it's $2,000. If you're a couple, it's $3,000. Your house is exempt, and 1 car or vehicle is exempt. They'll let you have those. And if there's a healthy spouse in your relationship, they get $126,420, just to make sure they're okay. What is a countable asset to Medicaid? There's no hiding. They're looking in your checking account, they're looking in your savings account, all your investment stocks, bonds, those all have to be sold down. You have to spend that money. You can't have it. Your second property, maybe rental properties or the second vehicle, you have to sell those. Bank CDs, annuities. How about your pension funds, your IRA? That was your emergency fund. What about your 401k? That was your retirement income. Those are your assets. They want those spent. So now you're probably thinking, well, I might not have the cash, but I have family. And what happens when your daughter or your son comes up to you and says, Mom, Dad, don't worry, I'm never gonna let you go to a nursing home. We love you. Okay, we've all been around the block. Let's just sit back and think about that for a minute. Who's really gonna be available? Let me tell you about my son and his lovely wife. He is so smart, and he always thinks about that. I always get a birthday card. I always get Mother's Day cards. He calls me up. How many people have a smart child like I do?
Of course.
Right? Okay. How many of those smart children are leading very busy lives? So who's going to be there? And what are they going to do? I don't know about you, but I have a son. I don't know if you think I'm crazy, but I don't want him in the bathroom helping me clean up after I've gone to the bathroom. I don't want him helping me take a shower. Is that crazy, or do you guys agree? On top of that, when we need care, will our family have the training to handle the conditions that we have? I mean, who can stay up all night like my Aunt Ginny? My Aunt Ginny needed 24-hour care. Oh, I should have a story to tell you. My aunt, the reason I'm so passionate about this plan, and I'll try to be quick because they're going to jump in. The reason I'm so passionate about long-term care insurance is because of my Aunt Ginny. How many people here have someone in their family who they think is going to just live the perfect retirement? My Aunt Ginny was so creative and so passionate about life. She created a whole early education school out of her own passion from nothing, out of her own creation. She created this early education style. And she was so active in the community. She's the one that made sure the lobsters were going to boil and the lobster boil on the beach. She made sure everyone was in the right order on the 4th of July parade. Everyone loved her. All of us thought, this lady is going to be active till the day she dies. She's going to fall asleep and just not wake up. How many people have someone in their family they look at that way? And yeah, until she was diagnosed with Alzheimer's. My Aunt Ginny and Uncle Bill did not have long-term care insurance. But they were very much in love. They went square dancing. They were obviously active together. They ate well. They cooked in the garden. They grew their vegetables in the garden and cooked together. They went bicycling. They were healthy. But suddenly, my uncle has to do her hair. My uncle has to dress her. He has to bathe her. He has to take the car keys away. My cousins, 2 families of my cousins, their children lived nearby. But each of those were married. Each of them had elementary or high school children. They were really busy. You guys have maybe been through that in your lives. On top of that, they jumped in with both feet and they tried to help their dad and mom through this. Well, it went from my uncle trying to keep my aunt's brain going by bringing her square dancing and having her play piano to the point where he was pretty much doing everything for her. And then after that, the dementia became so profound that he was staying up part of the night. He had to be on alert pretty much 24 hours a day to make sure she didn't go turn on the stove or walk out of the house, maybe into the street. She was not safe anymore. He was exhausted My cousins were exhausted and they were fighting with each other because everybody wanted to make this work. They wanted it to work. And what do you do when you're exhausted and you can't meet the need? You get mad at somebody else. And so they were fighting. Watching that happen to such a loving and wonderful family is why I'm here, making sure that that isn't the story that you guys have in your lives. The last way to pay for long-term care is with long-term care plan of some kind. And of course, this is what our topic is today. So let's get into long-term care insurance solutions, okay? So the first thing is, I bet it's in all of your minds, is how do I qualify for this benefit, even if I have the insurance? Well, the good news is, it's your doctor, your physician's assistant who decides that you're going to need care for one of two categories for at least 90 days. That's the long-term part. The short-term part, maybe Medicare will cover. So what are the categories? You need to have at least 2 out of 6 of the activities of daily living. Some of you are familiar with that, maybe through disability insurance or other types of insurance. It's pretty easy to think about if you think about getting up in the morning. What is the first thing you need to do? Hey, get out of bed, transferring. Go to the bathroom, toileting. Taking a shower, bathing. Dressing. What are you going to wear that day? Even if it's your lounging outfit because you don't feel so good, you still have to get dressed. Eating. I often think of Parkinson's. It's difficult to even get the food onto the fork and get it to your mouth successfully. Continence, more frequent. Incontinence is more frequent than you think. So pretty simple, right? You only need 2 of those. The other category is a category by itself. That would be my Aunt Jenny. Any kind of dementia that you need continuous supervision within arm's reach. So that could be dementia. It could be caused by a stroke. It could be something that came out of the blue, like a car accident. Anything like that would allow you to qualify. Pretty simple to understand. But let me give you an example. Maybe I don't need these. An example would be my Aunt Judy. Now I know that sounds the same, but she was here in Colorado. They lived outside of Evergreen. My uncle and aunt lived there. They raised their kids there. They were there for decades, part of their community. They were outdoors people. If there was a sunny day, you'd find them outdoors. Backpacking, hiking, canoeing, they did it all, bicycling. And my Aunt Judy, I don't know if anybody else has someone like this in their family, but she was so stubborn. She was like 5'0", petite, and she carried a backpack the same weight as my uncle, who was 6'3", carried. By the time she was in her late 60s, her shoulders didn't work anymore. She went in for surgery, one shoulder at a time. They did everything they could, but when she was done, this was as far as her hands went up. And there wasn't a lot of strength in one arm. Reaching behind her, oh, what does that sound like? Bathing, I can't wash my hair. Dressing, I can't put on my shirts and blouses and sweaters and sweatshirts. That's all she needed was the upper body help. At first, it was just fine. Well, not really. She was really frustrated. I'm sure I would be really frustrated. I bet you each would be frustrated to have to depend on someone to wash your hair, depend on your husband to put your hair up. He became pretty good at a braid. Anyway, for a long time, my uncle took care of her. He was always a really patient and kind person. and he would take care of her, but he'd been diagnosed with some dementia. At first, that was okay, not a big deal, and he would take care of her, and she would take care of him, and they got through their day until his dementia advanced. He started losing track of things like words and understanding sentences and maybe how do buttons work and how do I tie my shoes. So at that point, he couldn't take care of her anymore, but they had long-term care insurance. They bought it long ago. And even though it embarrassed her at first, when she first went in to make a claim, she didn't admit she couldn't wash her hair or put her clothes on. When she finally admitted it, the insurance company approved that claim in no time at all. The money paid for this sweet gal who came in every morning and every evening, helped her through her routine, and they were great. She was back to her life, out at the art museums and training people on wildlife and all the things that she did for fun. My uncle, however, was now the issue, because now here she is, can't move her arms so well. She was helping him. Well, she's in her 80s now. Now she's 91, but she was in her 80s and she couldn't take care of him so well. So again, they turned to their long-term care, and even today, he's going to be 92 in about a month. He's still living at home together with his loving wife, because the gal who came in the morning and the evening became the senior sitter, the person who came in and made sure everything was okay every day. What a relief. Can you imagine what a relief it was, first of all, to both of them? They're still together. They're still in their own chairs, their own bed, their own kitchen. And for all of us, especially their children, imagine how relieved they felt knowing that their parents were taking care of. Their children were helpful too, again, busy, but now they didn't have to fight or worry about whether their mom and dad were okay. They were okay. They were still actually doing a few things on their own and going to movies and classes. Isn't that really what you want for your family? Isn't that how you want your family to feel comforted and knowing that you're safe and healthy and well cared for? That's what we're here to talk about today, how to make sure that that happens. The next most commonly asked question is, well, what's covered? Isn't it just nursing for nursing home? Take a look at this list. I challenge everybody in this room, can any of you come up with a place you might receive care that's not on this list? Good, we've got it covered. They call it a comprehensive plan. Our next question is premiums. It's not going to be specific, but nowadays, in the last 15 years, premiums typically remain the same or fairly stable. For certain types of insurance, they're guaranteed to stay the same from the day you buy the contract. For other types of insurance, they're health insurance. They don't rise as fast as your individual health insurance policy, but they will probably rise over your lifetime. Your value of your policy can grow annually. Premiums are based on your age, your health, and the benefits that you choose. So let's face a few facts here. I know, I turned 61 this year. It's hard to say it, but I'm the youngest I'm going to be for the rest of my life. We all are. And I'm probably the healthiest I'm going to be for the rest of my life. We all are, right? So if you want the lowest premiums, get them while you have the advantage of your age and your health. Benefits chosen, that's a personal decision, and the more you want that insurance company to do for you, the more they're going to charge you. It's basically an exchange. There are a lot of ways to pay for premiums, and some of these ways will be more important to some of you than others. There is no right way, and there is no complete option. Not every type of policy will have every way to pay for it. For now, if something in here strikes you as, oh yeah, that might be something important to me, write it down. Otherwise, we're just going to move on.
1035.
That's something to talk about outside. It's basically like for like exchange. If you had a life insurance policy with value, say you bought one while your kids were small and it's grown, you could exchange the value of that policy for a similarly structured long-term care policy. Now, there's a pretty word. Who likes that word? Tax-free. Okay, remember when we were trying to fund our long-term care coverage and we were looking at all the ways we could fund it? Well, we kept running up against the tax man. The benefits you receive from your insurance policy, the payment from your insurance policy, is excluded from your income tax. Every single dollar goes to pay for your care. That's a pretty sweet deal. Premiums themselves are a deductible medical expense, but not everyone can deduct them. So do talk to your tax man. If you're a small business owner, there are ways to deduct premiums through your business. If you're looking at an asset-linked or a hybrid plan, which we haven't discussed yet, but many of you have probably heard about, because they're a combination plan, they don't all fall under long-term care regulations, so they may only be partially deductible. Again, if you're a business owner, there are different exceptions. Now let's get into the choices we have to make in our policies. We're talking about benefits. The first choice we're going to need to make is what type of structure do we have available for our plans? Well, there's the individual plan. That's really straightforward. Let's say it's like your house insurance. It covers one house, you pay a premium. In exchange, if a tornado comes through like it did in Windsor not so long ago, pulls your roof off, your insurance company is going to give you a big pile of money to fix your house, money that you wouldn't otherwise have. That's what an individual policy will do for you. And like your house insurance, if you stop paying those premiums, what's going to happen to the benefits? They're gone. But that's a pretty fair deal. You're trading a small amount of money for a big pool of benefits. So most plans that are available as individual plans. However, if you have a spouse or a common law marriage or another tight relationship that's recognized, a partnership that's recognized in your state, then you can share a plan. If you share a plan, not only do you get the value of being able to inherit your spouse's benefits if they don't use them, but you can share the benefits. So that means you're more likely to cover more situations because you can share your benefits between you. It's twice the value. That's a really good deal, isn't it? So write down shared benefits if that's something that you think might be helpful to you. The next choice you're going to have to make is how much do you want the policy to pay you when you need care? Most policies will let you choose between as little as $1,500 and as much as $15,000. That's per month. Some policies will pay out by day, and they range from $50 to $500. That amount of money is a maximum. It's a cap. Most policies are reimbursement, so that's the maximum amount they'll pay on your bills. Some plans will even offer cash value. They'll pay you cash instead of reimbursing your bills. If cash might be something you're interested in, just take a note and we can discuss that later. Something that that 95% of people who do what I do, something that they're not probably going to discuss with you is being overinsured. What do I mean by that? My watchword here is mind the gap. When most people who do what I do recommend a policy, they may tell you what they think should be a good plan, kind of a one-size-fits-all. Or they may look at your financial picture and say, I know how to make a whole bunch more money right away on your assets, and they'll prescribe a plan. But what they won't say is that you're going to have to pay this premium the rest of your life. Do you want to be able to afford your premium when you're 70 or 80? You want a policy that you can afford. That's what I mean by mind the gap. You want to look at the difference between the actual cost you're going to have to pay and the actual cost of your care and what you can pay. For example, remember we were talking about $5,000 a month to pay for a full-time home health care aide. Let's say you want to pay $500 a month of that. Let's get the policy to pay 90%. Hey, that sounds really good to me until I look at the premium. That may not be a premium I can afford, especially once I'm in retirement. So maybe you want to look at an 80% coverage plan where the insurance company is paying a little less and you're paying more. Or maybe 70% is more in your comfort zone. You get the idea, right? You want to find a plan that's comfortable for you, that you can afford for the rest of the time you need to pay it. Don't be overinsured. That's my recommendation here. The benefit period is the next choice you have to make. You'll be able to choose on most plans between 1 and 10 years. There are a couple of plans that will give you an unlimited benefit for your lifetime. So if you're like me and you have Alzheimer's in your family, you might be looking at an unlimited plan. There are also other ways to handle that, but if you think an unlimited plan might be something for you, go ahead and write that down at least to discuss. The benefit period is the minimum amount of time that policy will pay you. What do I mean by that? To do that, let's look at a little bit of math. It's not too hard. So the first number we're looking at is that decision we made about maximum monthly benefit. How much do we want to be paid each month? Now, that's in months. The benefit period is in years. So we're going to multiply the monthly benefit times 12 months in a year. That gives us the annual benefit. Multiply it times the number of years that we decided we wanted them to pay us, and there's our policy value. So here's what the policy we've been talking about would look like. You've got $5,000 per month times 12 months in a year for 5 years. So our pool of money is now $300,000. That's our lifetime monthly maximum. That's a nice pool of money, isn't it? Think about if you were paying that money out of your own assets instead. That would be pretty comforting to know you had that in your back pocket, wouldn't it? The last thing that you have to decide about is inflation protection. This is the reason that I said your pool of money grows annually. Let's go back to our policy we've been discussing. $5,000 a month for 5 years, $300,000 lifetime maximum benefit. Well, most people I talk to pick a 3% compound inflation protection. If you use the rule of 72, it's really a quick way to decide when your money's going to double. Well, your money's going to double at that rate in 24 years. That means you will have $10,000 for your maximum monthly benefit in 24 years. Well, most people need their policy when they're roughly in their 80s. So all that time, that money's been growing. Guess what else grows? They promised you 5 years at your maximum monthly benefit when you signed up for your policy. So in order to pay you twice the amount of monthly benefit, they have to make your pool twice as big. And that's important because when you look around, everything's costing more, isn't it? The prices are going up and up. As a matter of fact, in 20 years, these are what things are going to cost. Over $100,000 for that home health care. $200,000 for the nursing facility. So wouldn't it feel good to know that your policy had grown over those 20 years to buy the same amount of care as the very first day you bought that policy? That's the magic of compounding. Now, for those of you who have written down that long-term care insurance is something that you should look at, we're going to do a quick review of the different types of policies. The first one that most people own is long-term care insurance, traditional long-term care insurance, like your house insurance. The benefit, hello? It has the most bang for the buck. What do I mean? I mean that for the premium size, you're going to get the biggest pool of money. Spouses can share benefits, and the surviving spouse can inherit the unused benefits. You can qualify for dollar asset protection offered by our very own Colorado Partnership Plan. I'll explain that in a minute. And as you know, it's 100% potentially tax deductible. That is a strong policy, isn't it? Write that down if that's the policy that you think might fit you the best. Now let's explain partnership plans a little bit. A partnership plan is an agreement made with Medicaid that if you use up your long-term insurance plan, you've received all the benefits and the pool is empty, but you still need more care, like my Aunt Ginny. People with Alzheimer's need 8 to 20 years of care because the body's still going strong. Well, after you've used up your pool of money, let's say they paid you that $300,000 and your plan was partnership qualified. That means Medicaid will say, okay, $300,000, we're going to set that over here with your house and with your car, and we don't need you to spend that down. That's going to stay your assets in your control. And then if you qualify, Medicaid will keep your long-term care in place. They'll keep taking care of you. And when you pass away, $300,000 is kept in your estate, protected from Medicaid clawback. And that is where they get to recoup from your estate the money they spent. Remember, you get to keep your house? That's the common place where they're going to claw that money back from. They'll sell your house and they'll say, we spent this amount of money, now pay us that portion of the house. Long-term care insurance is the only one that fully qualifies, that can fully qualify. But another type of plan that is very common and becoming more and more popular is the asset-linked or hybrid plan that's based on life insurance. Okay, I hear the voices right now in your head saying, I already have life insurance. This isn't a life insurance plan. All they've done is take advantage of certain regulations that apply to life insurance and combined it with regulations that apply to long-term care insurance, and they've put them together. That's so they can give you more benefits. You don't have to use it or lose it. You get a tax-free benefit if you never use the plan, if you never need long-term care. You can choose plans that'll reimburse your bills or plans that'll just pay you the whole benefit in cash. And even if you use up the full pool of money that you have, it'll still pay a residual death benefit, basically a final expense plan. You can pay for these plans all in a lump sum, get it over with, one and done, or if you're still working, you can pay it maybe over the 5 or 10 years that you're still working until then you don't have a premium to pay when you retire, but you have a plan. There are even a couple of plans that'll let you pay it like you pay for traditional long-term care insurance. Just pay a premium every month or every year until you need it. And one thing that'll summarize about this type of policy, and this is for all hybrid policies, they're about security and certainty. They're about not using it or losing it, getting something no matter what. And generally speaking, they probably cost about twice of what another plan does, but they typically have more ways you can fund them. The last type of long-term care insurance I'll talk about is the annuity-based solution. And again, this is not an annuity, but it's combined with annuity to give you more benefits. They accept the most health conditions. Long-term care insurance right now, they are declining 30 to 40% of the applications that are submitted. Hybrid plans, maybe 25 to 35%. Asset-linked annuity plans, they're going to cover a lot more people in their policies. And they pay a death benefit if you don't use it for long-term care. On top of that, they offer longer coverage, longer benefit periods than many of the plans. But typically, they're a single premium, so you'd have to, they're not for everybody. There are ways to fund it that we'll discuss here. If that seems like something that might be what you need, go ahead and write that down. If everything we've talked about so far doesn't sound like something for you, but you still want to keep your independence as long as possible, then you may want to look at some of the alternative options. Critical cash policies, those are great for folks who'd like some coverage, but say had a cancer and they want to protect themselves from a heart attack. It'll pay you cash if you have that condition. Recovery care plans. Those are for folks that don't qualify for long-term care insurance, but they still want to make sure that if they need to be in a nursing home while they're recovering, maybe they don't have those 3 nights in the hospital, they can get some coverage. They're easier to qualify for. And prepaid home health care plans. Those are for folks who can't qualify for other types of policies. All you have to do is say, hey, I can take care of myself right now, and you can become a member. But they'll pay for care at home. The last choice you have to make that can help you stay home longer is a short-term home health care plan. They're very affordable, a few $100s a year. And they can help you recover at home. They pay you cash. And when you recover, after your doctor said you're recovered for 180 days, you get to use that plan all over again. So write down the plans. If there's any one of those that might fit you, maybe combine them with something else, we can talk about those later. So what plan is right for you? Look around at all the different kind of people we have here. Okay, I don't know. I can't give you an answer that's going to work for every single one of you. But I'll give you some rules of thumb just to get started. Basically, if you've got a lump sum, if you've got $100,000 a person that's sitting in some safe asset that's not making much money, an asset-linked option with a lump sum payment, that might be the solution for you. If you're living on a limited budget in retirement, which most of us are, you might want to look at long-term care insurance, a traditional policy. Or if you have less than $35,000 in income in your retirement years, or besides your house and a car, you have less than $100,000 in assets, you might want to look at a combination of a recovery care plan or a home health care plan and planning for Medicaid. So, what's your next step? You've reached the finish line. If anybody wrote down that Medicaid planning is your next step, I hope you'll take advantage of the fact that you've had local attorneys who specialize in elder law to talk to. They're well worth your money to go in, plan ahead. They'll help you understand what you can do with estate planning so that you aren't bankrupt if you need Medicaid. That would be your next step. If you cannot afford a long-term care, an elder care attorney, please pick up one of our free brochures or call up the Office on Aging. They're a wonderful free resource, and they'll help connect you up with all the things available in our community. Thanks for watching my video. If you found it helpful, please click like. And if you know someone in your family or at work or just a good friend who would also benefit from this information, please share it with them. If you are interested in future videos about how best to protect your retirement, click that subscribe button. And for a free conversation with me, please sign up on my calendar. I have a link right below this video at the very top of the video description. You can also email me or phone me, and I'd be happy to explore how I might be able to help you. Thank you.